Yeah, so you guys asked me to do a little update on the financing environment for the space sector, which of course is an interesting topic at the moment. So I'll just go through a few points since we don't have that much time, and I also do want to leave time for Q&A at the very end.
Sure.
Just because this is about finance, I have to make the disclaimer that nothing here is going to be investment advice and so forth. Right. Well, Nicholas already told a little bit about myself. My main role is indeed being a space venture capitalist, investing typically early stage at the seed or pre-seed stage through my VC fund company called E2MC Ventures, which is currently on its second fund, has invested in about 15, soon 16 space companies globally, a lot in the US, but also things in Europe and Israel and India, and throughout the different subsectors of space, so satellite communications, Earth observation, and in-space manufacturing, and other things. I am also currently heading up one of our companies as an acting CEO, which is Prometheus, which is a space biotech company. And then I'm quite active in space outreach, which some of the viewers may know. I have a podcast, which I'll talk about, and I teach at a few universities on space entrepreneurship and finance. A few of these slides are going to have QR codes on them. This is basically taking you to places directly on websites where you can get more information. Right, so let's go through a few charts regarding the financing environment for space. So the first one here is looking at the public equity markets. And you basically have three lines here, substantially over the last little bit more than 3 years. And they're normalized to start at to have the same starting point. And the three lines here, where you have the NASDAQ, that's the top line for most of the time. That's the purple line. Then you have the S&P 500. That's the light blue line. And then the red line is one of the existing exchange traded funds or ETFs for space, the very creative ticker symbol UFO. It's been around for quite a few years. I think it's probably the one that has been around the longest among the space ETFs. So a lot of people would use it as a proxy. And you can, of course, see here that space really has quite significantly underperformed the broader public market indices. And this is not even before taking into account some of the space companies that became public through SPAC mergers, many of which are not even included in this particular ETF. Staying in the public markets, I mean, this is the same chart, but I just added some statistics for other publicly traded instruments here on the upper left. So again, and you always see here the percentage of the ATH, that's the all-time high. So how much is it down compared to the all-time high? And so the UFO exchange traded fund is down a little bit over 40% of the all-time high. There's another well-known space-focused exchange traded fund or ETF. That's ARK. ARK, as in the very well-known asset management firm headed by Cathie Wood. And that's also down almost 40%. What one should point out about that ETF is that although it's called a space ETF, it has a few companies in there which wouldn't traditionally be associated with space, but the argument is made that they have some indirect space exposure, companies like Netflix or John Deere. The third line here is quite interesting. That's actually a publicly traded space investment fund, Seraphim, which some of you may know from the UK. They have private, so not public, but private space VC funds. So like my own firm has as well, but they have one that's publicly traded. And that's down 67% versus the all-time high. And then there's another instrument in Europe. Well, there's actually a few others. I'm just picking out examples here, but there's one that has been around for a couple of years or so, actually a little bit longer, which is from a French asset manager, Financière Chiquier, and that is down also almost 50%. So really in the public markets investors have not had a great time with space unless they invested exactly at the right time and more importantly, got out exactly at the right time. Right, quickly reviewing, many of you may be aware, we materially increased the number of pure play public space companies substantially during late 2020 and early 2021 through this boom, or most people would say bubble with hindsight, of the SPAC mergers, so special purpose acquisition companies merging with space companies and hence taking these space companies public. And you can see here, it's been over a dozen transactions. I mean, there's a lot of information to read here, but it's over a dozen transactions. Again, various subsectors of the space economy, several launch companies, several remote sensing companies, even a lunar company recently, Intuitive Machines. And those, depending on when they went public, you initially could have made money with them, but by now they are all down very materially. That's here in the last column. You see quite a few companies are down north of 90% versus the all-time high. So again, not a very nice picture in the public markets. Moving over to the private markets, and this is just a chart from many of you may know another space VC firm called Space Capital out of New York. They're putting out, they're one of the firms putting out a quarterly update on the space financing environment. And here you see a bar chart basically of the investment volume by year. And really, I just want to show you here that 2022 has been unsurprisingly coming down certainly versus 2021, which again had this like massive SPAC and other activity, but even versus 2020 and 2019. Now, a couple of caveats to make here. First one is that many people, or everybody has their own different definition of what a space company is. Space Capital uses a very broad one, which includes, anything that is, can broadly be considered a space-driven application. You can use narrower definitions, which bring the companies closer to space, in which case those financing volumes here, the left axis, would be materially lower. I mean, you can see here, Space Capital has still 2022 even at around $20 billion of financing volume. If you use a more stringent definition for what a space company is, then you could probably easily cut some of these numbers by half. Now, the other thing to mention here is that sometimes there can be lumpy transactions in here. So as we'll see on another slide, whenever SpaceX goes to the market, and SpaceX, as an example, goes to the market quite regularly, that can be a few $1 billion of an entire year's bar. And that this is somewhere hidden in here. Continuing on the private market, I thought it was important to point out that, so despite this gloomy picture I've given you so far, and I think it's necessary for transparency reasons to point this out, and I think people are broadly aware of this, of the gloomy aspects of the financing environment for space. Here's some examples from the private markets, and they're all very recent examples. They're all 2023 examples that basically showing that private funding rounds, and sometimes even relatively significant ones, are still getting done, right? So again, here you see a range, and this is not every round from 2023, as you can imagine. This is just picking some prominent ones because these firms are, for various reasons, more prominent. And you see, again, space firms from various subsectors of space, whether that's orbit services, or we even have a lunar company in here. We have an EO company in here, diversified company in here. And they've gotten financing rounds done, and some of them are relatively material size. I mean, you have some smaller sizes in here, like Lone Star, the third row. That's 5 million. That seems small, but this is a company that wants to build data centers on the moon, and which arguably that may be a business model that many people would consider to be very high risk, out there, unclear, when revenue is going to start happening. And even they were able to raise their seed round of $5 million in this market environment. Then you have some larger rounds. So another one I want to point out is the fifth row down, the Exploration Company. This is a French company that's building basically a capsule that's designed for microgravity manufacturing. And this is not a seed round, as you can imagine. This is their, well, I suppose the Series A. And this is a $43 million round, which for a European company in this market, that's quite a significant size. And then you have some follow-on rounds from companies which have been around for a while, but again, you can't take it for granted that they get, their bigger rounds, and these are basically Series Bs and Cs done in this market environment, but they did. And so to point out here a couple, Astroscale, Japanese company, this is the fourth row down. They're engaged in active debris removal and some ancillary orbit services. And they recently announced a $76 million round. And the penultimate row here is another example, Capella Space, an American company engaged in Earth observation using synthetic aperture radar sensors. They were able to do a $60 million round. And then at the very bottom, the last, this is what I was talking about before, SpaceX always regularly comes back to the market. I mean, they're having very big, very ambitious projects. So the most recent announcement there was a $750 million round at the beginning of this year. Excuse me. Right. So now that we've been through some charts, I just want to go through some, in no particular order, to some of the things that we're seeing day to day in our jobs as venture capitalists, and so being right at the epicenter of this whole space financing environment. So first bullet point, very unsurprisingly, valuations have come down, even at the early stage. I mean, you can imagine they have come down. The closer you are to the public markets with this very visible benchmarks that I've shown you on the other slides, public companies being down over 90% versus all-time high, the closer to the public markets, probably the more you have suffered. But again, my space VC firm is focused at the other end of the capital formation spectrum, so at the very early stage. And I can tell you, even at the very early stage, by and large, on average, valuations have come down. It's always hard to put a very precise number on there, but if you really, really forced me, it depends on many factors like value in the world, exactly what stage are you, how good is the perception of your team, how risky is your business model in the current market. But something like 30 to 50% versus even a year ago at the seed stage, that's probably something I would be comfortable saying. So that's the first point, valuations are down. Second point, which is something that is making our lives as venture capitalists actually much easier, and you always see this in these types of market environments after you come off a bubble, which we arguably had with the SPACs, is that the people who still come to us now and pitch to us, they tend to be serious on average. And what I mean by that is that, even a year ago, 2 years ago, the financing environment was so good that you saw a lot of people who quite frankly, they didn't seem serious as founders. Many of them seemed very opportunistic. Just coming saying like, okay, this is a good market environment, why don't I throw together a pitch deck? And if I'm lucky, I'll walk away with, a few $1 million seed financing. And these people, I mean, this is one of our main jobs, I think, as a venture capitalist, is to sniff out that people have the right motivations, because it's extremely tough being an entrepreneur. And we can sniff that out, I believe. And I can tell you, these people are basically all gone now, which makes our job much easier, but it also it makes for a very good environment for investing at the moment. Third point, moving over to the investor side, so investors like us, many of us, not all of us, are substantially inward looking at the moment, making sure their existing portfolio companies are okay in the current market. But also many of us, including ourselves, we still continuously look at new opportunities, because again, I do believe this is a good market environment for investing. Fourth bullet point, and this is probably really not a surprise, the various kind of not so nice things that have been going on recently. Silicon Valley Bank, basically having to be rescued, Virgin Orbit furloughing its staff and quite visibly running out of money. I mean, these things are obviously not helpful at all in terms of the fundraising environment, and at all levels, right? It goes all the way down to VC funds like mine. It makes it more difficult for us to raise money because people are just worried at the moment. Fifth bullet point, unsurprisingly, current market environment, fundraising is tough. So what we see a lot of is, since those companies are trying to survive, is what we call extension rounds. So rather than moving, from a seed to the Series A and having a valuation uplift and doing a bigger priced round, we see a lot of companies basically opening up on the same terms as their previous round again, and incrementally taking in money to extend their runway. And many times that's on a rolling basis. We're certainly seeing down rounds. So down rounds, I'm sure many people know that's just a term for when your valuation is that ideally is always going up, when your valuation from one round to the next is actually going down. And we're seeing quite a few of those, most of which are not, the fact that down rounds is not public, so I'm not going to go into specific names here. And we're starting to see bankruptcies. And I suspect some of them are, probably the minority are known, like there's an example, Canadian launch company SpaceRide, and there's probably others where it's under the radar screen that they're effectively bankrupt or people bankrupt. So again, this slide has been a bit more on the gloomy side. So let's have another slide with bullet points observations that we currently have, which is slightly more optimistic. The first point being, which you saw on the other slide, I showed you the example fundraising rounds from 2023. Financing rounds for good companies continue. And as I've shown you, some of them in material size. And this, interestingly, some companies are even now trying the public markets again. We have 2 examples of that. So Intuitive Machines, a Luna company, basically is going through a SPAC merger right now. Sorry, has gone through a SPAC merger. It closed already. And iSpace, another Luna company. It's interesting, both companies are Luna companies. They're going to list in April. The plan is that they will list their shares on the Tokyo Stock Exchange in April. Third bullet point, very importantly and positively, the government support for the sector, and that is including funding mechanisms in all of its forms. It could be grants, but it could also be equity investment, or it could also be very often financing effectively through revenue via contracts. That is continuing, arguably it's increasing. Some of you may have seen the budget requests for NASA, for the US Space Force, and there's even new space agencies. So this is a trend we're generally seeing, that the government interest in space is going up around the world as space is increasingly seen as a really strategic activity. And of course, that's very beneficial as a backstop, also as a financing backstop for space companies. And we're generally seeing the interest in space increasing. And it's hard for me to pin this down scientifically, but I can just tell you anecdotally that space is becoming more prominent at some events which are not space events. So of course, talking about events, you have your big annual space conferences, but this year so far, for example, I have been to the World Economic Forum in Davos, and there was a material number of space events, panels, keynotes. And then very recently, just last week, South by Southwest. So again, a very big general, not space specific event. And there also was a not insignificant number of space sessions going on. And then the last point, something unsurprising in an environment like this, is that consolidation is continuing. So United Launch Alliance, very important US launch company, is up for sale. It's publicly known. And we had some other transactions going on just this year. Vast, the space station company, buying Launcher, a propulsion company. Voyager, a diversified company, making yet another. They've already made many acquisitions. They made another acquisition of a company called Zen. Right, so a few messages I want to leave to various groups. I don't know exactly who's listening in here, but if you're a founder, this is a difficult environment, but you can get through this. It's important that you husband your cash and you extend your runway. So do this extension rounds if you can't get a full price round done. Go for grants, because again, governments are still giving out grants, and if anything, that's increasing. And if you can, try to convert CapEx into OpEx, which is increasingly possible in the space sector. What I mean by that is, so for example, if you can host, if you're an EO company and you can just host your sensor rather than having your own satellite, that's probably a good idea. For investors, and unsurprisingly, I would say this being an investor myself, I think the environment is actually really positive. The macro trends, like the cost decreases in space, that these macro trends are still intact. And if something like the Starship launch, the orbital launch is going to work, they're even going to accelerate. And the other macro trend I talked about is the continuing government support. As I said before, valuations are more attractive than they were 1 or 2 years ago on average. And as I also already pointed out, the founding teams tend to be quote unquote better. And so, yeah, in some way, I think it is a great time to invest. And then lastly, I just want to leave you with some other resources. I was talking about my outreach activities. So if you want to learn more on an ongoing basis about space and what's going on with space startups, I have something called the Space Business Podcast. Here's another QR code that's going to take you directly there. I typically interview space entrepreneurs, sometimes other investors, sometimes other interested people from the space sector, like astronauts or academics. There's a few online courses out there. This is one by the Swiss Institute of Technology, where I'm the main lecturer on the space economy. I've written a space economy book, which is available in German and Portuguese, and the English version was already out, but it's being revised. It should again be out in a couple of weeks or so. And this is it. So that leaves us about 5-6 minutes for Q&A.
Perfect. Wonderful, Raphael, again, for providing this overview. And again, it's a very interesting times, as you're stressing, right? So there's bad points and good points, but overall, what we're seeing that some of the companies are not doing good. And again, that's a bit sad to see. So for example, we had a ex-CEO of SpaceRide today also presenting Again, the company, it's been now under the Deloitte wing. I think so. Deloitte was the company that took it over, and but I got a few questions, and there's some questions in the chat as well. So first question will be, Rafael. So now that we're seeing again the companies, the valuations going down, and that means they have to give up more equity to get the same capital, and even that is more challenging, right? At the moment for them to do. How will that affect the space ecosystem long term, especially for younger companies now that they have to delay again their fundraising, let's say for the Q1 of 24, for example?
What I think a certain shakeout is, I mean, let me try to see the silver lining. A certain shakeout is healthy. I mean, things had run too hard, arguably, in many subsectors of space, and to a large degree, we're coming back to a more normal situation. So of course, it feels tough for many founders right now, but again, if you look back in history to other sectors, whether that's blockchain or the internet 20 years ago, I mean, these phases happen. Typically, it's very healthy for the overall sector because it cleans out the excess. There's sort of a period where the investor psychology is a little bit damaged, right? Because people have lost money, and it would be better if people had made money. But there is smart investors who study the history of investing in general, and they share my belief that, well, for space, maybe this is now exactly the best time to get in. And again, it's no surprise I'm saying this, but I believe these people who get in now, a few years down the road, they can probably make a lot of money, and so that's going to be very positive for them and the sector.
Much more that they would have made, let's say, in the previous couple of years if they were investing. So yeah,
certainly, yeah.
That's a great point. Again, for investors, it's a good time. So my next question is also, when investors, again, especially in space, and space being a risky industry, especially when they invest in space tech companies, right? So how do they make sure that the investments that they make are more accurate, and they have some certain more screening process, obviously, compared to other industries? And maybe you speaking from, again, being a financial individual from the fintech industry in the past as well. So how do you generally compare and how it differs, again, the investors' mentality in the space industry and, let's say, in the fintech industry?
Yeah, so I'm not greatly familiar with, I mean, I have been in the fintech industry in the past, but that's quite a few years ago, so I'm not greatly familiar with the current mind frame. What I would say, comparing something like, or let's just say comparing space tech, or what are the, let me phrase it differently. Like, what are some of the things that make the space sector different? And one key thing, of course, is this is a very deep tech sector, right? Like, this is like, phrase that we very often use in everyday life, and we want to describe something. So when we say something is not rocket science, right? When we say something is actually not that hard, it's not rocket science. We're here.
This is literally
this is literally rocket science. I mean, not every single part of the space sector, right? I mean, there's obviously lots of space activities which are not rocket science, right? I mean, but actually most of them still then tend to be very complicated, right? They tend to be activities where, if you don't know it yourself, and a lot of the stuff is very specialized, so there's typically you don't know it yourself, you really should bring experts. I mean, we compare the complexity of this as a deep tech sector very often to something like biotech, right? It's, again, of course, we would say this as a space VC fund, but it's not something that we'd recommend that like a generalist investor or a generalist family office should wake up and say like, oh, now we're doing space investments. There is a certain there's really quite a material amount of work you have to put in to develop the expert knowledge, but also to develop an expert network, right? Because the space sector has its own network, and this network then allows you many things. One thing it does allow you is to find the right experts for technical due diligence, but then further on, it also allows you to add further value once you've invested to companies. So this is all to say that, again, unsurprisingly, this is the reason we formed a space specialized VC fund. We think there is a role for space specialized investors, where journalist investors can outsource that type of work to us, because it is extremely difficult for them to do that, and it's risky. And we have seen some, I'm not going to single out anybody, any situation, but we've seen some, let's be transparent, some stupid investments being made during the bubble by people who were just too excited. And of course, I'm very excited about space, but too excited, didn't do the due diligence, and they either already got hurt or will get hurt.
Yeah, so exactly. There's a lot of this again dynamics happening within the industry, and it's hard really for an individual that's not been involved in the industry for quite at least some time, to really make those accurate decisions when investing, especially when dealing with VCs from other industries. So there's a question from Antonio in the chat as well. So he asks if you could stress a little more how you see the impact of the Silicon Valley and Signature bankruptcies on venture capital in the space ecosystem.
Yeah, I mean, this was another one of these things which we wish we didn't have to deal with, right? I mean, as we know right now, fortunately, the situation is significantly better than about 10 days ago. I mean, there was some days, basically from Thursday, not last day, but a Thursday a week ago, like Thursday, Friday, Saturday, parts of Sunday, where everybody was very nervous, right? Because there was sort of two levels of exposure for the venture capital and startup ecosystem. First was that many, especially US-based, Silicon Valley-based, quite a few VC firms had their funds at Silicon Valley Bank, right? And it was unclear of, would you be able to access your capital? Would you be able, hence, to deploy your capital? So that was one level. The second level, of course, was the portfolio company level, right? Like, which of the VC's portfolio companies had money at Silicon Valley Bank and would be able to access that and do everyday things, like most importantly, pay payroll, right? And there was really a risk at some point in time that if the uninsured deposits weren't safe, that basically you would have a snowball effect, right? You have some startup not being able to pay its employees, not being able to pay its suppliers, which then those suppliers would go through the same thing, even if they weren't customers of Silicon Valley Bank, right? But I think the sector and the ecosystem and the regulators, of course, they realized this immediately, and this is why this deal was struck, right, to basically guarantee the uninsured deposits as well. So it's obviously, there's sort of two effects, right? There's the tangible effect, and I think the tangible effect on the deposits, that's fine now. For all we know, they're safe now. I mean, I often joke, but I think could actually be true, or it probably is true, that Silicon Valley Bank right now, the Silicon Valley Bridge Bank that has been taken over by the FDIC, it may be the safest bank on the planet. It's literally owned by the Federal Deposit Insurance Corporation. So why would you go anywhere else now? I mean, we probably did the same thing as many other people, right? Many people called around and frantically, started the process of opening new bank accounts. But arguably, actually, SVB Bridge Bank is many reasons to believe it's a safe bank now. But that's the sort of tangible effect. What's more unfortunate is I think there's going to be a lingering psychological effect, right? That people went through these few days of raw nerves, and that wasn't pleasant. And that may have like a psychological aftermath of just people sitting back for a little bit and just not deploying as quickly as they previously would have thought.